Welcome to This Explainer. Today, we're completely tearing down the walls of financial confusion and, well, demystifying your money. We're going to take a really close look at savings, insurance, and investments, taking all that complex, intimidating jargon and breaking it down into simple, easy-to-grasp truths. So get comfortable, because we're about to completely change the way you look at your personal finances.
So let's just dive right into this. Is your money really safe? You probably think that hoarding your cash in a basic savings account or keeping it tucked away in a safe somewhere means it's totally secure, right? But what if I told you there are literally invisible threats actively eating away at your hard-earned cash while you sleep?
10%.
Yeah, according to insights we're exploring today, particularly from educator Consur, the average rate of inflation impacting our daily lives often feels like a staggering 10%. And what does that actually mean for you? It means your money effectively loses half of its purchasing power every single decade. So leaving your money idle, that isn't playing it safe at all. Actually, scratch that, it's a guaranteed loss. Here's our quick game plan to rescue your financial strategy today. First, inflation, money's silent killer. Second, the insurance and savings mess. Third, investing by taking a loan. Fourth, right insurance, term and health. And finally, mutual funds and SIPs.
All right, let's kick things off with Section 1, Inflation, Money's Silent Killer.
Think about this fantastic point from educator Consur. Imagine if someone borrowed 100 rupees from your parents back in the 1990s. Back then, that money had real heavy weight, It could pay for a month of school fees or a really nice jacket. But if they came back today to return that exact same 100 rupee note, it holds almost no value. It literally wouldn't even buy you a decent meal anymore. That right there is the silent theft of inflation.
Let's make this super relatable. Let's talk about a samosa. 10 years ago, you could easily grab a samosa for 5 rupees. Today, that exact same samosa from the exact same vendor costs 10 rupees. And let's be honest, it probably hasn't gotten any bigger. So here is the absolute crucial takeaway. If someone promises to double your money in 10 years, they aren't actually making you any richer, because in 10 years, that doubled money is only going to buy you the exact same amount of samosas it buys today. You haven't grown your wealth. You've barely managed to stay in the exact same place. Now, to supposedly combat this, the system offers what I like to call liquidity traps. Governments and institutions, well, they don't want too much cash just floating around out there, so they entice you to lock it up. They'll offer you endowment plans, Sukanya Yojana, and your classic fixed deposits. But you've got to be careful here. As financial creator Ankur Warikoo rightly points out, even fixed deposits in banks are only insured up to 5 lakhs by the government. Anything beyond that, that is entirely at your own risk. Moving right along to Section 2, the insurance and savings mess. Financial analyst Sagar Sinha highlights a pretty stark reality about the confusing khichdi, or mess, we create when we try to mix our insurance with our savings. On one side, we have traditional endowment plans. People buy these thinking, great, I'm saving money and getting insured. But the harsh reality is that the agent who sells it to you takes a massive 25 to 35% commission in that first year. And your actual return? A measly 4 to 5%, which, as we just learned, doesn't even beat inflation. Now contrast that with pure term plans. Agents rarely push these because, frankly, their commission is tiny. But for just around 600 rupees a month, you get absolutely massive life cover. Now, I know what some of you might be thinking, but I only trust government companies like LIC. Private companies will just take my money and run. Well, the solvency ratio completely shatters that myth. This ratio measures an insurance company's actual ability to pay out claims, and the regulator mandates they keep a massive reserve. LIC sits at a very strong 1.87, sure, but private players like Tata AI and Bajaj Allianz have incredibly high ratios of 4.32 and 5.0. So rest assured, private insurance companies are heavily regulated and financially rock solid. Okay, Section 3, Investing by taking a loan. Let's unpack this one. Let's look at some really eye-opening math provided by analyst Anurag Singh. Let's say you take out a 10 lakh rupee personal loan and just dump it all into a mutual fund. Your EMI is going to be about 13,215 rupees every single month. And sure, in 10 years, that lump sum might grow significantly. But what if, instead of taking that loan, you just invested that exact same 13,215 rupees every month using your own money as an SIP, a systematic investment plan? Well, the SIP strategy yields over 51 lakhs over 10 years, and you do it without owing the bank a single dime.
The absolute bottom line here, a loan gives you EMI stress and heavy taxes. With a loan, you are living with the daily, grinding anxiety of having to repay the bank. You can't just take a day off work if you want to. Plus, when you finally make a profit on that borrowed money, the government is still going to hit you with a 12.5% long-term capital gains tax. Borrowing money to invest is just a massive trap that ultimately only feeds bank interests. Which brings us to Section 4, Write Insurance, specifically term and health. Look, here is literally the only definition for life insurance you will ever need. Term insurance is pure protection, period. If you pass away, it provides a massive multi-crore lump sum to your family to replace your income. That's the whole shebang. There is no messy savings component, no empty promises of getting your money back in 20 years. Because remember, money back in 20 years is just going to be eaten by inflation anyway. You've got to keep your insurance and your investments strictly separate. And going hand in hand with life insurance is health insurance. Guys, this is absolutely non-negotiable. A single totally unpredictable accident or illness can generate a hospital bill of over ₹1,00,000 the literal moment you walk through those emergency room doors. Without health insurance, you're forced to break those fixed deposits, sell off the assets you worked so hard for, or worse, take out predatory loans. Health insurance is the shield that protects the wealth you are trying to build.
All right, our final stop, Section 5, Mutual Funds and SIPs.
As we've established, if you just leave your money sitting in a basic savings account earning 4%, inflation is going to eat it alive. Mutual funds, as explained beautifully by educator Drew Vrithey, offer a brilliant solution to this, diversification. So instead of putting all your hard-earned money into one really risky stock, a mutual fund pools money from tons of investors, and an expert fund manager spreads it out across dozens of companies, in equity or safer government bonds and debt, or a hybrid of both. It's like a giant puzzle. If one piece, or company, fails, your whole portfolio doesn't come crashing down. Now, check out this mind-blowing math highlighting the power of long-term compounding from entrepreneur Sandeep Maheshwari. If you just set up an SIP of 10,000 rupees a month, historical market returns show us there is a very, very strong possibility of having 1 crore rupees after 20 years. Honestly, that is how you outpace the samosa inflation we talked about earlier. You consistently put your money into the market, and you just let time do all the heavy lifting for you.
Now, you might be sitting there wondering, okay, this sounds amazing, but how do I actually go about doing it? Well, as creator Akash Prasad lays out, it is just 3 dead simple steps right on your smartphone. Step 1, open a demot and trading account through any standard broker app. Step 2, do a little research and select a mutual fund that fits your personal risk appetite. And Step 3, set up auto pay. Seriously, this is the absolute magic step. The money leaves your account on a specific date every single month before you can even think about spending it on something else.
And hey, if 10,000 rupees sounds like way too much for you right now, just pay attention to this number, 500 rupees. That is literally all it takes to start an SIP. You can enter the wealth building game for the price of a couple of coffees a month. There are absolutely no barriers to entry left. Which brings us to one final really important question to ask yourself. Are you still sitting around waiting for your money to magically double in some outdated scheme while inflation just quietly robs you blind? It's time to stop leaving your money idle. Separate your insurance from your savings, protect your health, and let SIPs do the real heavy lifting for your future. Thank you so much for hanging out with me on this explainer today. Keep learning, keep investing, and go take control of your financial future.